I do believe that the stock market, has been discounting this for a good part of this year. The market is in a bear market. So the equity market's not going to be surprised, and even the fixed income market's not going to be surprised. The yield curve, so the difference between the 2-year and the 10-year Treasury yield, is over 80 basis points, 0.8%. This has not happened since the 80s, the early 80s, when Chairman Volcker, was taking a sledgehammer to inflation, an inflation problem that had built There we go. There we go. So what you will see as inflation unravels, interest rates come down, raising the present value of future cash flows. That kind of environment benefits our portfolio. We have stocks in our portfolio, companies that are going to be extremely profitable in the next 5 years. Right now, they may not be that profitable because they're investing aggressively to capitalize on some amazing opportunities in the genomic space, robotics, energy storage, artificial intelligence, blockchain technology. They're investing now because many of these are going to be winner take most markets. So they're huge markets. And therefore, there's latent profitability. The gross margins in our portfolio, so just taking a cost of goods sold from revenues, the gross margins are very high. And what they're spending on R&D, sales and marketing, stock-based compensation to attract talent in these early days is really important to their future success. So as interest rates come down, the present value of future cash flows going out 5 years, the present value of those increases.
Cathie,
I think a change in rhetoric toward, hey, maybe we're not going up after 4.5%, or a change in rhetoric will get the market going. The market is trying to figure out how high is high. And you've got some observers, economists out there thinking it could be 6 or 7%. And so the market is holding back and saying, wait, we need some evidence. Now, I think the evidence is becoming very strong because long bond yields are down at 3.5%. The long bond market does not think interest rates are going to 5 or 6%. It's been moving in the opposite direction. We got up to 4.25 on the 10-year Treasury, and now we're down to 3.5%. So the bond market, I think, is speaking pretty loudly, and the bond market itself, which would be the most sensitive to rates going up, is moving in the other direction. Yes, we have never seen a market like this. This is worse than 08, 09. And I think many technicians basically took a chart of the tech and telecom bubble and the bust, and they said, okay, that's what's going to happen. That has happened to us and more. This is worse than the tech and telecom bust. The difference between the two periods is we've got into an irrational market in the late 90s. Investors were piling on technology stocks, actually trying to outcompete indexes and each other. So they ended up with 40% technology, but the technologies were not ready. We didn't get cloud until 2006. We didn't get breakthroughs in deep learning until 2012. Not only were the technologies not ready, the costs were way too high. To sequence the first whole human genome, it took $2.7 billion for one person's genome in 2003. Today, that's 500. The technologies are ready, the costs are low enough. The seeds for what we're investing now were planted during the 20 years that ended in the tech and telecom bubble. That was irrational. And I think we're on the flip side of the bubble right now. I think what's going on right now is irrational. Many of our stocks are below where they were at the low point in 2020 when COVID hit. Some of them are back to 2017 levels. And a company like Teladoc, its revenues are up 14-fold since. Its gross margins are in the high 60s, we think moving into the 70s. And that compares to the NASDAQ's 43% gross margins. See what I mean about latent profitability? They have a lot more to spend to make this backbone of $3.25. This is as irrational on the downside as the upside was in the late 90s.